The coffee giant everyone thought was unstoppable is crashing harder than a dropped espresso cup. With nearly 40,000 locations worldwide and revenues approaching $40 billion, how is Starbucks suddenly becoming one of the biggest losers in the entire stock market? The answer might shock you, and it reveals something alarming about where consumer spending is headed in 2025. Picture this. You're standing in line at your local Starbucks, watching the barista frantically juggle mobile orders while the line stretches out the door. That frustrated sigh you let out? You're not alone. Starbucks is facing what might be its biggest crisis since the company nearly collapsed during the 2008 financial meltdown. But this time, the enemy isn't a global recession. It's something far more personal and immediate. Let me paint the full picture of what's really happening behind those green and white logos. When Starbucks stock hit its peak in July 2021 at over $125 per share, everything seemed perfect. The pandemic was winding down, customers were flooding back to cafes, and the company was promising investors explosive growth. Fast forward to today, and that same stock has plummeted by double digits, making it one of the worst performers in the entire S&P 500. The numbers tell a devastating story. For years, Starbucks was the golden child of Wall Street, missing earnings expectations only twice between 2021 and 2023. Then 2024 happened, and everything fell apart. The company has now missed Wall Street expectations multiple times, with their third quarter revenue falling short by a staggering $130 million. But here's where it gets really interesting and disturbing. The problem isn't just about coffee anymore. It's about a fundamental shift in how Americans spend their money, and Starbucks found itself completely unprepared for this new reality. Think about your own spending habits over the past year. Have you been more careful about where your dollars go? Have you started questioning whether that $5 latte is really worth it when gas prices are through the roof and groceries cost twice what they used to? You're part of a massive consumer behavior shift that's crushing companies like Starbucks. The company admits they were banking on customers who looked like the aspirational consumers of 2022 people willing to splurge on premium experiences. Instead, they're facing value-seeking consumers who scrutinize every purchase. This miscalculation is costing them billions. Here's something that'll blow your mind. Starbucks is seeing incomplete mobile orders in the mid-teens. That means people are literally putting drinks in their cart, seeing either the wait time or the price, and then abandoning their order entirely. Imagine running a business where 15% of your potential customers get to the checkout and just walk away. That's the reality Starbucks is living with right now. I decided to test this myself by placing a mobile order at a Manhattan location during peak hours. The result? My drink was ready in just 3 minutes. But here's the kicker. I've been to that exact same location before, and it's taken upwards of 20 minutes. This dramatic improvement isn't accidental. Starbucks is desperately trying to fix their efficiency problem because they know long wait times are killing their business. Survey data reveals that 25% of Starbucks customers say their wait times have gotten longer, up from just 16% 2 years ago. When you're paying premium prices, waiting 20 minutes for a coffee feels like highway robbery. This is where the emotional connection between Starbucks and its customers starts breaking down. But wait times are just the tip of the iceberg. The real crisis runs much deeper, and it's fundamentally changing what Starbucks represents in American culture. Remember when Starbucks was your third place, not home, not work, but that comfortable space where you could relax, meet friends, or work on your laptop? That identity is disappearing fast. Former CEO Howard Schultz, who built the Starbucks empire, publicly criticized the company's direction, emphasizing that they're becoming too transactional and losing their experiential magic. This transformation is happening at the worst possible time. As Starbucks tries to become more of a convenience play to compete with mobile ordering, they're suddenly competing directly with McDonald's, convenience stores, and every other quick service option. The problem? Those competitors are often cheaper and sometimes faster. Let's talk about the price shock that's driving customers away. A latte at Starbucks has increased by about 25% since 2020. While McDonald's latte prices have gone up by over 40% during the same period, McDonald's is still significantly cheaper. For price-conscious consumers, that math is simple. Why pay more for a longer wait? This pricing pressure forced Starbucks to do something unprecedented: enter the value wars. Summer 2024 marked the beginning of what industry experts call the fast food value wars, with McDonald's, Burger King, Wendy's, and Taco Bell all launching aggressive bundle deals. Starbucks, a company that built its reputation on premium pricing, suddenly found itself offering discounted pairings menus. This represents a seismic shift in Starbucks' business model. The company that never had to compete on price is now desperately trying to prove its value. But analysts warn this approach might be missing the point entirely. When customers complain about price, they typically want cheaper base prices, not additional free items bundled with expensive drinks. The international picture is even more alarming. In China, what was once Starbucks' second-largest market and a key growth engine, the company has lost its crown. A competitor called Luckin Coffee has taken the top spot, nearly doubling its store count in just 1 year and leaving Starbucks trailing by almost 4,000 locations. This isn't just about losing market share. It's about losing relevance in crucial growth markets. While Starbucks continues expanding globally, opening new stores in India and trying to maintain its Chinese presence, critics question whether the company should be expanding internationally while its home market is struggling. The internal challenges are just as serious as the external ones. Starbucks has been battling union tensions, particularly with Workers United, which represents some of its employees. The company's historically progressive benefits package became a point of contention when new benefits were automatically extended to unionized stores, creating friction with workers and potential customers alike. Adding fuel to the fire, social media boycotts related to the Israel-Hamas conflict have impacted sales in various regions. While these boycotts might represent a vocal minority, they demonstrate how quickly brand perception can shift in our connected world. But here's what makes this situation even more fascinating. Starbucks isn't actually a failing business. With $36 billion in net revenue and control of over 26% of the US coffee and snack shop market, they're still the dominant player. The second largest competitor, Krispy Kreme, holds less than 3% market share. This isn't a company in dire straits, it's a giant that's lost its direction. The turnaround efforts are already underway. The company is implementing something called the Siren Craft System, which includes adding play-caller roles to help during busy periods, digital production management through iPad systems, and resequencing how beverages are made to improve efficiency. These changes represent a return to operational basics, focusing on the fundamental customer experience that made Starbucks successful in the first place. There has also been reports of activist investor Elliott Investment Management working with the company to boost stock performance, suggesting that significant changes might be coming from the boardroom level. The question isn't whether Starbucks will survive. They will. The question is whether they can rediscover their identity in a world where consumers are increasingly price-conscious and have more options than ever before. Can a brand built on premium experiences adapt to a value-driven market without losing its soul? This transformation reflects broader changes in American consumer behavior that extend far beyond coffee. As we head into 2025, companies across industries are grappling with similar challenges. Customers are more selective, more price-aware, and less loyal to brands that don't deliver obvious value. For Starbucks, the path forward requires balancing efficiency improvements with the experiential elements that originally set them apart. They need to prove that their premium pricing delivers premium value, not just in product quality but in overall customer experience. The company that once revolutionized how Americans think about coffee now finds itself needing another revolution. Whether they can pull it off will determine not just Starbucks' future, but serve as a case study for how established brands adapt to rapidly changing consumer expectations. The coffee wars are just beginning, and the outcome will reshape an entire industry while revealing crucial insights about where American consumer culture is headed next.